Got to be careful of that because you're not doing any research yourself, and so you're just jumping on board someone else's advice, and that's typically when people get burnt.
Investors Podcast episode 3 in the books, happening. We're ready to rock and roll. Really cool topic. We kind of obviously are building out a bit of a journey at the moment for everyone to go on through the Investors Podcast. And obviously it's a massive pillar of what we're trying to do here, life-changing conversations. And I think wealth and the ability to build wealth plays a big role in opportunities, being able to take opportunities and understanding that the reality is money and wealth does play a role in happiness to a certain point. So giving people insight into that and how they can start to take steps and kind of make these leaps and bounds is something that we want to do. And obviously we're talking about investing because I think that's something, some people have a job, they'll have a business, they'll have all these different or have different circumstances, but the one thing that everybody has in common is the ability to invest from this point on, obviously if you have access to it. So one thing that we talked about with one of the issues that people face is active versus passive investing, right? So and there is no right or wrong here. It's more so individual. What kind of time do you have? What do you actually want to do? How risk averse are you? All these kind of questions. But I might throw it to you now. And what do you actually mean by active investing versus passive investing?
Yeah, so active investing is obviously when you take a more hands-on approach. You're dedicating your time. You're dedicating your learning capacity, and you've got a desire to learn about individual companies, or it could be anything, could be whatever niche you're in, and actually spending the time to actually research those areas and then applying a lot of your energy to that. Whereas passive investing is more about just sort of setting money aside and letting it roll over into some sort of investing vehicle that you can then just sort of rely on as a savings vehicle, as opposed to just trying to build up your wealth via knowing exactly what you're investing into.
So I would assume that, my mind automatically goes to obviously risk. One being more risk with much higher reward, which is the active investing, and the other being a lot more having a lot more stability, right? So you're not going to get as higher returns, but you can probably get those more constant returns where you know that it's probably going to be around that 10 to 20% mark.
Well, you're letting someone else do the hard work for you. So when it comes to passive investing, you're typically investing in something like an ETF or a REIT or something along those lines that you just sort of roll your money over into every week, every month, whatever it may be, and that takes care of itself for you. Purely because you either don't have the time to invest into researching different investment vehicles, or you just don't have the desire to, because you're focused on your career or your family or whatever it may be.
So I want to go back to, because I think that's the most important thing, right? Is as I said, that we both agree that there really is no right or wrong way. There's just what suits you as an individual. And passive investing is for that person who's not as risk averse. They probably don't want to spend the time doing it. They know that they want to get into it. They know that it's going to get them a return, and it's a part of their wealth building journey. You mentioned an ETF, and you mentioned some of these different options that you have there in terms of passive investing. What is an ETF? How does somebody start to understand where to find this and potentially what.
Well, this is where it gets a little bit more difficult because, again, you probably need to spend some time researching into all the different ones.
Yeah.
So an ETF is essentially a managed fund, either from a hedge fund or something along those lines, where you have really smart people looking after that money for you. And it's just a mass of wealth from different investors, and they put that money to work for you. They typically take a fee for their time and their hard work, but ultimately they do all that hard work for you, and you can rely on their knowledge obviously knowing a lot more about it than what you probably do. Um, but oh man, there's so many out there though. That's the thing.
So I guess an example is just like the S&P 500.
Yeah, S&P 500, which factors in the top 500 companies either here in Australia or over in the US. That's the general market, and that's probably the one that people think of first when they think of investing into just a hedge fund or whatever. And that one's pretty good because that's where you get your historical average of 7-8%, whatever it may be. And then you have more of them like your ARCs and that sort of thing that are more tech and innovation driven.
Shout out Kathy Woods.
Shout out to Kathy Woods.
The G.
Otherwise, there's so many. Like you can find ones that are focused on energy. So it really comes down to what your preference is, I suppose. But the way to look at it is it's kind of like your super. You know, super is exactly the same thing. They're an ETF that's investing your money in the long term. And what do you do with your super? You contribute, or your employer contributes towards that every paycheck or whatever, and it builds up over time. And that's the same way that you should be looking at investing into an ETF. You just put some money aside every paycheck, roll it over into that, and over time that will gradually increase.
Yeah, and I guess so looking at it from that perspective, then, you know, no matter what, you're going to have to do some research. But I guess when we're looking at, say, passive investing, so someone who doesn't want to dedicate that time and energy, their options is to go out there and try to find an ETF that either suits maybe potentially the brands they like, or how aggressive they want to be. You know, you talked about ARK Invest, and I think the difference is like, you know, you've got the S&P 500, which kind of gets you that 10% return average around about that. But then you look at something like ARK, which they invest pretty heavily in innovation. So they're very futuristic in the way they think, you know, investing in things as such as robotics, AI, futuristic internet, sustainable energy, all these types of things. And they have a lot of different ETFs, biotech as well now, space travel. So they're investing in a lot of these kind of futuristic technologies, these really innovative technologies. And that, you know, I think, I don't know what they're at right now, but I know that for a while there they were getting, 70% returns.
So they average, I think ARK's main one, ARK K, they generate, I think it's 25% year over year, which fantastic return compared to your 10%, which is what your typical S&P 500 is. But the way to differentiate the two is ARK is focused on what's happening in the future, whereas S&P 500 usually focus on relevance, but also what has succeeded in the past. So typically they're not going to grow as quickly because a lot of their growth is already factored in, and they're typically paying out more in dividends because they've they don't know how to innovate anymore. So there's nothing else to spend their money on other than rewarding shareholders. So that's the way to differentiate the two, because your ARK, they're reinvesting all of their money, if not still raising money from the private market or the public market, in order to drive growth and drive innovation in those two spaces.
Yeah, okay, so there's two questions I have for you then, right? And I guess two topics that I want to follow on. The first one is, you talked about dividends. So a dividend is something, it's basically a company will pay you out for the shares you hold in that company. And what you're saying is the reason they do that is to actually hold on to the investors, to keep the investors.
That's to reward their shareholders, yeah. So essentially it's retained earnings, which is essentially their profits. And they'll set aside a certain percentage of that to return back to those shareholders who have been with them the whole way. So a company like Coca-Cola, which has gone through this massive growth phase over the last 100 years or whatever it is, they're at a point where it's become really hard to innovate and to create new products. And so they've just got all this money sitting on the balance sheet as retained earnings. Better to reward those shareholders who were with them from the early days, like a Warren Buffett sort of thing, and now he gets his however many billions for being a loyal shareholder. He's been invested in them for the last 30, 40 years or whatever it is. And so that's how they typically spend their money these days.
Cool. So you can invest in potentially an ETF or even a company that can pay you a dividend, and that's where you actually, instead of just making money on the stock, you're actually getting money transferred into your own account as well. And that's where what you're saying is, if you invest in some of these companies that are a little bit safer, they've already had their success, they've already had their growth spurt, and they're solidified themselves in society as a company. You can get that dividend, and obviously you're paying for that security. The follow-up question is more around, it's probably less around informative and more about preference, but when we're looking at something like inflation, right, and I think this is something that has to be factored in this conversation right now. You look at something that the S&P 500 is getting you a 10% return. It's almost like a hedge. You could put your money in that knowing you're going to get that 10% return. I don't know exactly what inflation's at the moment, and I know some of the numbers can be, they can sometimes paint the incorrect picture or the numbers that we get shown. But investing in something like the S&P where you're getting that 10% return, if inflation's at 8% or whatever it's at, and for those of you who don't understand inflation, it's obviously the money that's hovering in society, pushing fixed assets up in price and the cost of living up. That's why housing prices are going crazy at the moment.
Consumer goods as well. Coca-Cola's recently said that they're raising their prices. Johnson & Johnson, so a lot of our skincare and shampoos and conditioners and all that, that's all now going to increase in price. You everyday shop at a supermarket has probably gone up, spending more on utilities, all that sort of thing.
Yeah, so I guess it's not really a question, but it's a statement that I want you to follow up. But getting in the S&P 500 where you've got that 10% return, for those of you or to give you a better understanding of inflation, is if you've got $50,000 sitting in your bank account, if inflation's at 10%, it's basically saying that year on year that money becomes 10% less worthy.
Yeah, your purchasing power decreases by that 10%.
Yeah, so you're not. It's still going to be that same amount of money in your bank account, but what that money can do for you will actually start to decrease over time.
Exactly, and so this is where investing becomes so relevant, because you can then grow that money at a pace that is quicker than that inflation. Obviously, yes, there's going to be times where there's a downturn, but typically, if you hold for the long term, I think the stat is if you hold for 20%, for 20 years, there's a 99% chance that you're going to be successful in the market. That's a pretty good statistic to have, and you're going to outperform that inflation over that course too.
So then when we're talking about active and passive investing, we're going, well, passive investing is almost a way to, you're going to get that return, and you might even get better returns than what inflation is currently at.
Yeah,
but
it's a way to preserve your wealth.
It's a way to preserve your wealth, and I think that's really important for people to understand. That's why investing is so important. Like, just hodling cash in your bank account is actually, because of inflation at the moment, it's actually decreasing your purchasing power, as you said. So passive investing is a way to, as you said, kind of preserve your wealth. And I think that's important for people to understand from a psychological perspective as they're investing, right? Yeah. So me and you are active investors, especially you, but we're looking for companies that are going to actually not just preserve our wealth, but actually help us build it. And even ETFs, right? So, you're looking at something like, we mentioned Cathie Wood's and ARK before. They're getting that 25% year on year. And over the last 12 months, I think they had, 70% at some of their best ones, which is crazy. So if inflation is at that 8 to 10% and we're getting 70% returns on our money, we're actually starting to build wealth now. And I think, that is a really good kind of way for us to understand the difference, or I guess the psychology for everyone out there, on whether you want to really start to build wealth, which is active investing, or you pretty much just want to preserve your wealth so that your purchasing power still stays there. And that's almost like with property as well, right? Like, you invest your money in property so that your money will hold its value, and you can then borrow against that equity.
Yeah,
in the
you
future.
build up that equity. Yeah, exactly. And so they're basically the same premise. Investing in a fund like an ETF or whatever, and also investing in property. It's the same premise, because you're building up that equity and you're relying on that capital growth to sustain that wealth that you've already accumulated. And by increasing or by adding payments towards either one, you are slowly building up that equity, which obviously lays you into a good foundation into the future. Same principle applies with your superannuation too. So the more you contribute to that, it builds up, and then that's what you rely on to retire on, essentially. But you could still be doing the same thing with the money that's sitting in your bank account, and that's what is so important. Because as you said, if you keep it sitting there in your account doing absolutely nothing, your purchasing power over time will slowly diminish.
Unless, and I think this is again, like, yes, saving cash is important if you want to be able to get leverage. And leverage is, when we mean leverage, we're saying debt. If I want to be able to buy a house, I have to save the money to get that purchasing power. But I think the beautiful thing about investing in stocks and these kind of things is it's liquid, and it's real time. Yeah, you don't necessarily have to go into debt in order to.
And it's probably best you don't go into debt either.
Yeah, exactly.
Definitely don't trade on margin, no.
No. Okay, so then we flip the script now and we go into active investing. What is active investing? Give us because this is your nutshell, right?
This is what I do, yeah.
This is what you do. This is your profession.
So there's all types of different active investments so I spend all of my time researching into various companies, looking for metrics that I resonate with in order to get the best return that I possibly can. But there's all different types. So I could use leverage. I could be trading options. I could be using derivatives. I could be day trading. I could be swing trading. So there's all these different types.
You can also do active investing also doesn't just exist in this realm. Like, you can be an active investor with property, and that's what a property developer is, right?
Yeah, or flipping houses or whatever the case may be. So yeah, there's examples in whatever asset class you choose. I just happen to be mostly equities.
Yeah. So then when we're looking at, okay, let's kind of dive in. When we're active investing with stocks, what's the process, right? So you said that you would research companies. So if someone out there right now is not an active investor, but they might want to become an active investor, what advice do you give them?
Shit, okay. I would probably start with the brands that you know and you resonate with the most. So you look at a brand like Apple. So when they first brought out the iPhone, I was a late adopter to the iPhone, but as soon as I got it, I realized that this thing's here to stay, and they're building out this ecosystem with the iTunes store and the App Store and all that sort of thing. And I knew that was just going to get bigger in time. And if you had have invested in Apple back in those days, back in the GFC and that sort of thing, you'd be up tenfold by now. And the same applies to, you could invest in what else? Wherever you buy your groceries from, so you could buy into here in Australia. It could be Woolworths, could be Coles, could be IGA. If you've got a phone plan, you might want to invest in Telstra. That's probably the best way to get started, just with brands that you're aware of, that you associate with every single day. And then once you sort of build up that solid foundation, and once you have skin in the game too, that's when it really does make a difference, because you start to get a feel for how the markets move, and you can sort of try to disassociate your emotions with that money as well, because money is just a tool that you can use to obviously enrich your life. But yeah, so the sooner you start to build a solid foundation and you start spending more time learning about it, that's when you can start to look into I suppose it depends on what your interest is. For me, it's technology, and so I've spent a lot of my time researching different technologies and how they work with their network effects and all that sort of thing. But it could be biotech, it could be energy.
But I think the first thing is and one thing you mentioned before is the fact that when you're active investing, you actually have to do your research.
Yeah, you got to be spending time. It's a full-time job.
Yeah.
For me anyway. It could be something you do part-time if you've got a normal job and you want to build your wealth. So I guess it'd be like a side hustle, and you still have to dedicate time to that side hustle.
It's like a business, right? If you want that business to prosper, you have to actively do your research on the product and these kind of things. And I think a lot of the time when we're talking about active investing, we're saying, cool, you actively have to go out and research companies. And it's actually quite interesting at the moment, right, with the whole crypto space, because you're almost seeing a lot of investors that are new to the game just jumping on things that are getting inflated by
It's the whole FOMO. FOMO's driving it all, isn't it?
by influence, right? Like,
Yeah.
Elon posts about Dogecoin and all of a sudden everybody's investing in Dogecoin. Like, people are investing in
But
Dogecoin.
you got to be careful of that because you're not doing any research yourself, and so you're just jumping on board someone else's advice, and that's typically when people get burnt.
Yeah.
So often people will come to me and they want to learn about investing, they want to learn about active investing, and they'll mention a company that they're looking to get into, or I might mention a company that I recently invested into, and I go to them and I say, don't invest in this company, but go away and do some research and come back to me and tell me why I'm investing in it. Because if they can do that, they're now shown that they've done the work, So it's always beneficial to do your own work into it before you actually invest, rather than taking someone else's opinion. So, I remember you used to come to me with all these hot stock ideas, and I'd be like, "What research have you done?" And you're like, "Oh, it's just a hot tip." Tip. One of my mates invested.
I've had two hot tips in my life, and both of them have gone down 80%.
Well, there you go.
No more hot tips.
Exactly. And so often, it is beneficial maybe to invest in them and take that hit so that you can learn from
It's
it.
like betting on my mate's horse, though, right? Like, it's like, hey, my horse is running tomorrow. Like, chuck $50 on it. It's like, that's almost the mindset you've got to take with it.
Exactly. But if you're actually wanting to do this and be successful at it, it's like anything. You've got to put in the work. Jordan didn't get good at basketball just from rocking up on game day. He's in there in the gym working relentlessly. Same applies in this industry. This one just happens to deal with numbers and money.
And that's your most emotional.
Oh,
that's
exactly.
the most emotional thing in life.
Yeah,
and I think that's the crazy thing about right now, right? It's like there's so much speculation going on, and I think it's. I mean, and to be fair, like, I'm still in my infancy. I love doing the research. I'm lucky because I love reading about business. I find it also helps me as a business owner. But it's crazy. Like, I remember.
Well, from a business perspective, it's often handy to do your research into a company, say, within your field that you're looking to invest in, because you can take away principles and different practices that they're incorporating in their business, which is already a proven business that you can then apply to your own.
Yeah, like, I'm trying to build a business school at the moment, and it's interesting, like, reading up on Coursera.
Yeah, you're invested, aren't you?
Yeah. So how Coursera, how they generate their revenue, what their growth's like. Is this industry going somewhere? What's their business model? Who do they partnership with? Where are their beachheads? Where do they get all their customers? Like, all of these things are really interesting. What's their network effects like? And how do they kind of, what's the utility of the software? And all of these things kind of factor in, and then it just starts to shift the perception of how I view it, which is something that I really love. But it's interesting. Like, I think once you shift your mindset as an active investor and you start to move away from these hot tips and the speculation, I think back to my first real big win that I had on OpenPay. I got in at like nearly 40 cents, but that wasn't a hot tip. That was research I did.
It's based on fundamentals and sound research.
Yeah.
And you were investing into a business that was going off the back of the success of Afterpay.
Exactly. And that was what initially made me look. I wanted to look, what are the other companies out there? And the thing about OpenPay that I loved was they were doing the same thing that Afterpay were doing, except they were doing it in different sectors. They weren't healthcare. They weren't like home hardware. So they had the contracts with Bunnings. And I go, Bunnings is huge. Yeah. They were in talks with England. Now they're the biggest provider in England. Like, they just announced the other day. I'm out now, by the way, but now they're the biggest provider for England for automotive and hardware. And so I got in, and I think I ended up getting about 10x on it. But compared to the quick tips that you get on companies you know nothing about, I think the thing about that is you don't know when to sell, and that's the most important thing. You don't know when to sell.
Well, you're basing everything off the price. And if you're investing for the unless you're a day trader or you're a swing trader, that's the last thing you want to be worrying about. When you are investing into businesses that you want to hold for the long term, the price is the most irrelevant thing possible. You want to just make sure that you're investing in a very sound business that has strong fundamentals, has strong leadership in place. If you buy into a company that is $100 a share, but all of those things are checked off, that thing will be very cheap in the long run. You know, that thing might grow to $1,000 a share, like when I invested in Shopify. Same thing applied. At the time, they were considered very expensive, and yet they've grown into this multiple because they've grown so much because their business was rock solid. And it's only benefited more because of COVID.
So what are those fundamentals then? Because I think we can say invest in these fundamentals, but what are the fundamentals? So as I was saying...
So that's different for anybody though. So for me, I look at a business that is cash, like has a lot of cash on the balance sheet. They're not carrying a lot of debt. They've got strong cash flows. They don't necessarily have to be profitable, but you want to see that they're
that
working
doesn't make
towards cash flow
sense.
positive.
Like, so for somebody listening to that, that's not going to make sense, right? So they don't have, so they're not profitable,
Yeah.
but they've got a lot of cash on the balance sheet. So
Yeah. They could have raised that money though.
yeah,
So,
I understand
okay,
it, but for people at home.
So they could have gone out and done a public offering where they would have diluted their shares in order to raise money from either the public market or from VCs or private equity or something like that in order to continue to grow their platform and their users.
So what that means is, like, you know, basically you're generating cash from something. It could be a loan, it could be shares, it could be something like that. That cash then sits on the balance sheet as working capital. But this company still isn't actually profitable.
Yeah. But then I want to look at a company that is growing those cash flows so that they're at a point where they can be self-sufficient in the future. And so we've recently seen Tesla's just become cash flow positive.
What you're looking for, like when you're looking at some of these, like this is what the results are, right? So companies release results on a quarterly basis. So you could have a company that may not be profitable, but what we're looking for is revenue growth. What we're looking for is improved gross margins, because you want to see that their margins are getting better over time. They're not getting worse at producing whatever they're producing. You want to see maybe they may not be profitable yet, but they're becoming more profitable. So they might be negative 20%, but we want to see them getting to 15%, negative 15% next quarter.
Yeah.
And we want to see that kind of, and that's what Tesla's done. Like Tesla, you know, everybody kind of almost loves to sink the heels in or sink the slipper into Tesla and kind of get on their back. But the reality is over time, they've gone from a company that didn't really make sense, but they've just continuously produced results and gotten better and better and better to this point where they're now profitable, which is a good sign of, you know, think about if you had invested in Tesla from those good signs back in the day. Well, good leadership, or you could argue there's no better in the world. You know,
and they had the access to cheap capital too, so
Yeah.
they were able to have quick cash injections onto their balance sheet in order to keep their operations going, in order to grow their user base and all that sort of thing as well.
And what you mean by that, right, is the fact that they had great leadership means that they could get that access to cheap capital. Like, you got Elon Musk. There's probably not many people out there that aren't going to give Elon their money.
Any business that's led by a great marketer has that ability to raise money really quickly and easily. Like Amazon with Jeff Bezos, he is probably a number one example of it. Reed Hastings with Netflix as well, another company that was just able to grow because they were able to just put money onto the balance sheet. And then even though they're spending it left, right and center, they've now grown into these valuations where they're now cash flow positive and now turning profitable.
And that's what you're looking for when it comes to leadership. You're looking for some of those people ahead of their time, you know, like thinking about the modern age, right?
This mostly applies to technology companies though.
Yeah.
Different metrics apply to different industries.
Yeah.
So banks is a very, very different ballgame. Telecom, another different ballgame. Energy, insurance, all very, very different.
If you're an active investor, right? So this is probably a question. If you're an active investor, we talk a lot about, you know, what are these companies that are going to get you that exponential growth, right? And we talked about passive investing versus active investing. And then there's probably another level above that where it's like you're trying to invest in companies that are going to be or give you that exponential growth. And I guess what you said, that you're invested in technology, and reading between the lines for the people at home is you're looking for that exponential growth. And I think that's the thing is when you, and Mike Maples talked about this on a podcast, and he said, you know, Mike Maples owns Floodgate, which is a venture capital firm. So they basically invest in companies, provide that money that we talked about on the balance sheet so that it can grow at the early stages. But he talked about inflections and almost what I think on a very I mean, there's probably a lot more to it, but on a very basic level, he's talking about trends. He's saying, what are the trends? Where's the world going? And you want to try invest in companies that you think are futuristic in with their product, their leadership, and have the ability to generate that cheap capital. But their business model, their product, and everything is looking towards the future, because that's where that exponential growth comes in. Like, you invested in Shopify years ago, right? So, throughout COVID, Shopify just went bang.
But
boom.
that's because I was able to identify the macro trend that we were moving more towards an e-commerce sort of world, as opposed to retail stores and that sort of thing. So that's where your second and third level thinking comes into play, which is a lot of what Nassim Taleb talks about in Black Swan. You need to have those second and third level thinking in order to really make it profitable investments. So a key industry that has been really hot, that hasn't performed so well, has been the cannabis industry, which is so saturated but also very low margins and that sort of thing. And so people have been trying to jump on board the cannabis industry and determine which one's going to be the best performer. The best performer has been a hydroponics company. The company that provides the actual equipment needed, so not actually the technology of cannabis, but instead the supplier. So I think it was GrowGen. That's the company. And they've grown, I don't know, stupid amount over the last couple of years, and they've been the biggest benefactor as opposed to these cannabis companies. And so that's the way that I look at it. You have to first identify the macro trend. Once you do that, look at the players within that field, and sometimes you have to throw a bit of money, do the VC sort of thing, throw a bit of money and spray it over a couple of them and hope that one of them is going to be the one that wins out. The others may lose, but that's okay.
I think that's kind of like, that's the Tesla, right? It's like people look at Tesla as a car company, and then that's why they can't seem to justify the price. But in reality, you talked about the hydroponics company being the most valuable in that industry. Well, Tesla's producing a lot of the technology that's going into sustainable energy.
Yeah, they're a battery company.
Yeah, they're a lot bigger than that. And I think that's your second and third order thinking. Like, if you look at Tesla as a car company, it doesn't make sense. If you look at Tesla as sustainable energy, and you think the world at some point is going to move towards this model, these guys are so far ahead of everything that you'd be silly not to be invested in them, because what you're relying on is other companies being able to produce the same technology at the rate, at the scale that they are. And they've got a product that is already solidified in society that now that's almost the platform for them to be able to take it to that next level. And I think that's that second and third order thinking that allows you to see exponential growth, right? And that's almost like with me with OpenPay, right? It's like, I looked at OpenPay and I go, okay, is this business model going to be around? Is it proven? Yes. Well, Afterpay have done it, and they've done it really well. Okay, well, what about OpenPay? And I did my research. I did my research into Zip. I did into all of them. I didn't get into Zip, but that ended up going bananas. But OpenPay for me was like, it's highly differentiated. Is healthcare going anywhere? No. Are houses going anywhere? No. Is Bunnings going anywhere? No. That was enough for me to say, okay, I think at the least, do I think I can make money on these guys? Hey, at 50 cents a share, I'm going to take a punt, right? And then I think I sold out at around $5.50. So it ended up working out really well. But yeah, I think that second and third order thinking as an active investor is really important.
Yeah,
and
critical.
You only get that from that research that you were talking about.
Yeah, that's it. And that you get that from also the people that you follow on your socials and the people that you surround yourself with every day. Because you want to be talking to people who are in the know, and they have a sense of where the future's going. If you're just in your inner circle and you're not having these sort of conversations, you'll never have that second and third order thinking.
I think it's so important. I reckon this is probably the final subject, but I mean, the power of social networks, and this is in anything in life. This is, you want to become a better person. You hang around bad people that do the wrong thing, and their moral compass isn't the right area. You're going to eventually evolve into that kind of person. If you want to become wealthy or you want to build wealth, unfortunately, being in a poor environment surrounded by poor people, that's not going to help that cause. And it's the same with basically anything. If you want to become a good investor, the people you follow. We use Twitter, right? And I love Twitter, right? It's one of those things that I don't use it like other social media platforms. I'm only following 20 or 30 people, and I might check it once every 2 days. But when I check it, I'm like reading for like maybe an hour or two. And I think if people could start to use social media as their social network and actually start to build their social network and who they spend their time with around where they want to go in life, that's power. That's how you grow a business. That's everything in life. Social networks are absolutely everything. You talked about it before, network effects. So do you want to elaborate on that a little bit, right? What you mean by who you follow, who you surround yourself with, who you talk to?
Well, so I've actually now started incorporating people who have conflicting views on my own and the people that I follow. Yeah, because that's one way for you to challenge your thinking, and to develop a resolve around the decision that you've made. So that's, in my opinion, one of the best ways to be accountable to yourself, is to follow those conflicting views and actually challenge your way of thinking. And that allows you to have those second and third order thinking principles as well. But yeah, I'm the same. I follow your Kathy Woods, your Elon Musk, and these sort of people on Twitter, your Jack Dorsey, all these sort of people who are in the know and who are building towards the future. Because they're the ones, those forward thinkers are the ones that you want to be capturing in your day-to-day life, because that builds on your subconscious. And if you can build that into the way that you do things, you start applying those principles to your own actions, and it's just the way the world works. You want to be pulled forward, and these sort of people are pulling people forward, as opposed to having someone try to push you up the hill.
100%.
Yeah.
All right, Investors Podcast, episode 3 in the books. We appreciate everyone for listening. We're getting a lot of support at the moment, so we really appreciate that. I can't say it's actually quite rewarding for us, but it's also great to hear how people are actually using this information and saying, this has really helped me. This is really good. So we really appreciate the support, guys. Without you guys supporting the podcast, we actually can't continue to do this. It just doesn't make sense. So the support and the messages and everything helps keep pushing us forward, and we're going to start kind of building this out and really trying to build what is the hub of life-changing conversations here. But the other thing that we need is we need to also know what you guys want to hear. Yeah, we need to know what you want to learn, so that we can start to put together episodes and go find guests for you guys in all of the different elements, all the different episodes we're putting together. So really appreciate it, and we'll see you next week.
Cheers.